Hey, hi guys. Welcome again to, I guess, part two of my video series. If you hadn't watched my intro video, I'd encourage you to go watch it. This is the actual first proper video, and I'll be speaking today about personal income tax. There've been a lot of misconception around, whether taxes are going to increase by, 1st of January 2026, and people are afraid that they will pay more taxes, and people who haven't been paying taxes before are also concerned that they will get start paying significant taxes. So my job here is simple. I'm going to be calculating your taxes right in this video, and you would see and confirm for yourself whether the taxes are going to increase or not. But for the records, just so it's clear, my personal view is that personal income tax has not actually increased. In fact, for if for any reason, if for anything, it's actually reduced for low income earners. And I'm not holding brief for the government, so we are going to calculate the taxes, and we would see. But I just want us to understand, how these taxes are calculated, so it would also help you in terms of your planning. First of all, every income you earn in Nigeria is taxable, whether it's salary, or income from the rent if you own a property, or dividends or interest, any kind of income, including something called benefit in kind. So if your employer gives you a property to live in, or buys a car for you, that's the benefit you derive from those kinds of employment, those that are not cash benefits. So, like they give you stock options, they give you, you have stock options, you have cars, you have houses, they pay school fees for your children. Those are benefits in kind. They're not coming as cash to you, but they are taxable. So that's a general rule. There are a lot of things, there are a number of things, not really a lot, but that the law allows you to deduct from your gross pay to arrive at your taxable pay. We'll be looking at each of those items on, when we are doing the calculation. And in terms of where you pay your taxes, you're meant to pay your taxes in the state where you reside. So if you live in Lagos State, you're supposed to pay your taxes in Lagos. So what happens is your employer will deduct your taxes every month and remit it to the Lagos Internal Revenue Service. Same applies to every other state in Nigeria. You may ask, what happens if you live in one state and you work in another state? Like most people live in Ibadan, and they work in Lagos. They come to Lagos for work by train. And some of those people even have a house in Lagos and their family stay in Ibadan. The law is, if you have two places of residence, right? One in Ibadan, where your family lives, and one in Lagos, for instance, where you live during the weekdays, and then you go home over the weekends. Those two places of residence, and they are in different states. If they are in the same state, of course, it's not an issue because you pay your tax in the same states where those two places of residence are. But if they're in different states, to determine where you pay your where your employer will pay your taxes, the law says where you have a house, your residence that is closest to where you work. So if you reside in Lagos during the weekdays and it's close to where you work, you will be deemed to be residing in Lagos for the purpose of your personal income tax, right? So that's sort of what the rule looks like. But not to go into the complicated aspects, I just want to simplify how this whole thing works. So I'm going to be sharing my screen, and I will show to you how to calculate your taxes. I had promised that I was going to show you how your taxes are calculated. So this is how it looks. You can see on this sheet now that I have assumed that this person earns 15 million naira a year gross. To check what that is on a monthly basis, you basically divide 15 million naira by 12. So this is the person's monthly gross take home, gross salary rather, not take home. Gross salary is 1.2 1.2 million, 1,250,000 basically. Now I'm going to calculate the person's taxes under the old law. So this is the old law calculation. Then we'll also do a calculation under the new law. So follow me carefully. Now under the old law, you're allowed to, before you arrive at the taxable income for the employee, you need to deduct the employee's pension contribution. The law says that pension contribution should be 8% of the employee's monthly emolument, which is supposed to be 8% of 1.2 million, 1.250. But then the law also says that monthly emolument must not be less than the sum of the employee's basic salary, which is here, housing allowance and transport allowance. So together we call it BHT. That's basic housing and transport. So most employers calculate your pension on basic housing and transport. So the sum of this, which is basically equals to 7 million plus 2 million plus your transport allowance, 500,000. So 9.5 million is the sum of your basic housing and transport, right, in a year. So we are looking at this on an annual basis because you calculate your tax on an annual basis and then you divide it by 12 to know what your monthly tax would be. So I'll show you. Now, the law also is that your employer will contribute 10% of this your basic housing and transport, while you, the employee, will contribute 8%. So we are looking at your own calculation now, employee. We are looking at what you can deduct from your gross salary. This is your gross salary to arrive at your taxable income, which is here. So we are going to run the numbers now. Your gross salary is 15 million. Your your pension contribution as an employee is 8% of basic housing and transport. So I'm going to do equals to 8% times this 9.5 million, which is the sum of your BHT. It gives you 760,000. The law also is, as an employee, you can contribute to something called the National Housing Fund, NHF. It allows you to get, loan to build your build a house that you want to live in, and the interest rate is very low. I think it's 6% per annum over a 20-year period. So if you contribute to the National Housing Fund, you can access the loan, right? So the law is that you contribute 2.5% of your basic salary, just the basic salary. So that means we are going to do the calculation equals to 2.5% times, this is your basic salary, right? Enter 175. Now remember, your salary structure has to be broken down like this, because if it's not broken down like this, it becomes difficult to calculate all of these reliefs, right? So you can see that I had to break it down structurally so that it makes sense. Now let's assume that you took loan to build a house for yourself, assuming, and then the interest on the loan, let's assume that every year you're paying interest on the loan at, let's just say 1 million, 1, 2, 3, 1, 2, 3. So your interest on your loan is 1 million every year. Then let's also say that you contribute to the health insurance, national health insurance scheme. So the law requires actually that under the National Health Insurance Act of 2022, every person in Nigeria must have a health insurance. So for people in paid employment, your employer takes out the health insurance for you. For people who but the law also allows you to take out an additional health insurance if what your employer is giving to you is not enough. So let's assume that you take out that health insurance. Let's say your premium is, you pay a premium, which is the subscription for the health insurance. And let's say in a year, your premium is, let's say 300,000, 1, 2, 3. Right. So effectively, your total deduction, what the law allows you to deduct from this your gross pay, is 2.2 million, right? So far, relief. There's another relief. I'm getting to it now. And so this is this is the net amount. When you deduct the these reliefs from the gross pay, you get 12.76, 12.765, right? So this is a deduction. So I'll put it in red. Good. Now, in addition to these reliefs that the law allows you to take out, the law also allows you something called a consolidated relief allowance, which is calculated as 200,000 naira, or so it's 200,000 naira, or 1% of your gross income. Now, the gross income is gross income for CRA, not this gross income. This gross income is your general gross income. There is a gross income for calculating your consolidated relief allowance, and that gross income is for CRA is your actual gross income less all of these allowable deductions that the law has allowed. So this is your gross income for CRA. So you notice that we have two kinds of gross incomes, and it's important to note that distinction. There is the main gross income, this one, right? And then there is the gross income for CRA. Now, the law is for your CRA, you pay 200,000 naira. You get a deduction of 200,000 naira, or 1% of this gross income plus 20% of the gross income. So whichever is higher between 200,000 or 1% of gross income. So let's do a quick math. We have 12.765. If I do 1%, 1% of 12.765, 1% times 12.765, it gives me 127,650. It is less than 200,000. So that means I will use 200,000 as the deduction, right? Because the law is either 200,000 or 1%, whichever is higher. You can see it, whichever is higher, plus 20%. So for the purpose of calculating my CRA, see the formula. I'm going to use, so let me do it again. It's going to be, my CRA will be equals to 200,000, right? Going to be equals to 200,000 plus 20% of this CRA, right, times 20% of this CRA. So this is my CRA, my 20% of the gross for this CRA, basically. So it gives me 2.7 million. Now my taxable income is now going to be equals to this gross amount for CRA minus the CRA. It gives me 10 million 12,000. So my gross income is 15 million, but what I'm going to pay tax on is 10 million, basically 10 million 12,000. So it is this amount now that is the taxable income. This is what I will now run through the tax table, right, to determine my tax payable. So I'm going to run the numbers now to show you. Under the old tax law, this is how you pay tax. You calculate your taxes. You do not generally there's no fixed tax rate. It is a graduated table. So under the new tax laws, what they have tried to do is that they have adjusted the rate so that the more income you earn, the more taxes you pay. But the less you earn, the less you pay taxes on. So that's why we are going to compare and see. So under the old tax laws, because remember we are still calculating under the old tax laws, the first 300,000 of this your 10, because this is what you are now calculating tax on. So the first 300,000 of this your 10 million is 21,000. So you're basically going to be doing equals to 7.7% times 300,000. So I basically moved this to this part so that it's easy to calculate. So 7% of 300,000 is 21,000. Another 11% of 300,000. Sorry. 11% of 300,000. Forgot to add the percentage, apologies. Yeah. So 11% of 300,000 is 33,000. Then the next thing you do is 15% of 500,000. That's 15% times 500,000. You get 75,000. Then you do 19% of 500,000. Because look at, this is the rule. The first 300,000 is taxed at 7%. The next 300,000, 11%. The next 500,000 is taxed at 15%. The next 500,000 is taxed at 19%. The next 1.6 million is taxed at 21%. So I'm going to be doing equals to 21% times 1.6 million. This is it. Now, over 3.2 million is taxed at 24%. So if you check, I'm going to add from here to here, it's going to give me 3.2 million. If you check this, you'll see it here. Well, let me add it again just so you can see. Equals to sum of this amount that I have so far. I've calculated the taxes on all of this amount. So you can see I've calculated the taxes already, right? So if I add it up, you would see that I've already calculated. So you see I've calculated up to 21% and it's 3.2. So anything above 3.2 million is taxed at 24%. So what I will now do is I'm going to deduct this 3 point because I've already taxed 3.2 million so far. I'm now going to do the taxable income minus the 3.2 million that I've already taxed. It's going to give me 6.8 million. So it is that 6.8 million that I'm now going to tax at 24%. So that's equals to 24% of 6.8 million. So that's what gives you 1.6 million, right? So I'm now going to add, so this is the total tax that I need to pay under the old law. So I've added it up already. So the sum of all of this. So basically, under the old law, my tax in a year would be 2.1 million, 2,194,880 naira. My taxable income before arriving at this tax is 10 million, but my gross income was 15 million. So there's something called effective tax rate. The effective tax rate basically is the sum of you're going to the percentage of your tax relative to your income. So how you find effective tax rate is going to be equals to the tax you paid. This is total tax you paid in a year divided by the total income, your gross income. So it gives you 14.63 million. Basically, so if you want to know, basically what it tells you is that your tax rate is effectively, your tax rate, you paid 14.63% of your gross income as tax for that year. That's under the old law. So we are going to run this same number, but we are going to do it under the new law. Remember that this is the effective tax rate, 14.63%. I'll put it in green, so we can always come back to it. Now, moving to the next tab. Under the new law, we have the same income that we used to calculate under the old law, but the rules have now changed slightly. It's the same, it's the same basic housing and transport. So we are going to still add up your basic housing and transport, which is this 9.5 million. So the rule has not changed for pension. It's still 8% of basic housing and transport. So 8% of your basic housing and transport. The rule for National Housing Fund has also not changed. So it's still 2.5% of your basic salary. The interest on your mortgage, we had used earlier under the previous law, we used, under the previous calculation, we said the interest was 1 million. So let's still use the 1 million here. Okay. Health insurance premium, we said 300,000. So let's still use the 300,000 here for health insurance. Okay, so now what has changed under the new law is that we remember that after we did this, we had something called, another relief we got was the CRA, right, which was 2.7 million. The law has deleted the CRA and replaced it with something called the rent relief. So the rent relief is 20% of your rent for that year, of rent paid, and at a maximum of 500,000. So what this means is that if your rent in a year is 5 million, right? If you paid rent of 5 million in a year, if I do 20% of 5 million, if I do 20% of 5 million, it gives me 1 million, right? 20% of 5 million is 1 million, but the law says you cannot deduct this 1 million. You can only deduct up to 500,000 of this money. So even if you pay rent of 10 million and your rent relief should have been 22 million, the law says no, you can't take out that 20% of the rent. If the 20% of the rent exceeds 500,000, you can only claim 500,000. So we are claiming 500,000. So we are going to add up all of these are all your allowable deductions, your rent, your reliefs. So if you add everything up, I've already added them up, it gives you 2.7 million, 2,735,000. It means that your taxable income is 12.2 million. Now your taxable income is higher actually under the new law. If you look at it, it was 10 million, 12,000 under the old law, but it is 12 million under the new law. So the important thing is when you now calculate it under the tax table, that's what now gives you a clear picture of what your tax is. So under the new law, the tax table has changed. Notice that here, before that, the old law, you were taxing the first 300,000, and then the next 300,000, and then the next 500,000, and then the next, 1.6 million, and all of that. But under the new law, the rates have changed. So, and if you check the rates, so you tax the first 300,000 at 7%, this at 11%, and all that. But the rules have changed. The first 800,000 is not taxed. It's taxed at 0%, right? Then the next 2.2 million is taxed at 15%. So I'm going to start. So let me start. The first 800,000, which is this, is taxed at 0%. So 0. The next 2.2 million is taxed at 15%. So 15% times 2.2 million, 330,000. The next 9 million is taxed at 18%. So equals to 18% times 9 million, 1.6 million. The next 13 million is taxed at 21%. Now, for you to even get to 13 million, you can see that you can't even get there. So your calculation actually stops. So let's do it. Because remember under the old calculation, what we did was you need to be checking, right? You've taxed 800,000, you've taxed 2.2 million. So far, this is 3 million, right? Then you now tax 9 million. So that's 12 million. So what that means is, let me explain what this is. The first 800,000 has been taxed at 0%. The next 2.2 million has been taxed at 15%. You still have a balance of 9 million. The next 9 million has been taxed at 18%. Now, if I add up all the things I have taxed so far, that's equals to 800,000 plus 2.2 plus 9 million. So far, out of this 12 points, this is taxable income. Out of this 12.265, I have taxed 12 million already so far. So what I need to now do is, I need to deduct, what I now need to do is minus this 12 million I've already taxed from my taxable income. So taxable income is 12.2 million minus what I have already taxed. That's 12 million. The balance is 265,000. So I will now tax the next, that 265,000, which is the balance, is what I will now tax here. So that's equals to 21% times 265,000. It gives me 55,000. So in essence, my total tax for this year under the new tax law is 2,005,065. Compare the total tax with what you paid under the old law. You were paying under the old law 2.1 million as tax, and your effective tax rate was 14.63. But under the new law, even though your taxable income has increased, but your tax has reduced because of the bands, right? The band have been expanded. So it means that your basically if your taxable income in a year is 12.265, your tax basically ends here. It doesn't ends at 21%. It doesn't even cross into the next band. So people that are earning more are the people that will cross into this band. So your effective tax rate is 13.37%, which is equal. So how you get that is the tax you paid divided by your gross income, 15 million. So it gives you 13.375, which is less than 14.63, which you paid. So the difference between the tax you paid under the old law and the tax you paid under the new law is, this was the tax you paid under the old law minus this tax under the new law. So you are paying 189,000 naira less taxes. And let me show you what this means for your take home, right? So it means that for under the old law, let me do the calculation for you under the old law. This is your tax for a whole year. So you would divide this your tax by 12. So this is what you'll be paying. This is your monthly tax. 182,906 is your monthly tax, right? Now, your gross pay is, your monthly gross pay is 1.2 million. So gross monthly pay was 1.2 million, 1.250 million. Your monthly tax is this. It means that your take home monthly is going to be this, your gross minus your monthly gross minus your monthly tax. So this is what you were taking home under the old law, right? 1,667,093 naira, right? So this is under the old law. Let's do the same calculation under the new law. Under the new law, your gross is still the same. It's still the same 1,250, right? Which is your gross divided by 12, annual gross. So it's still 1,250. But now your tax is 2 million. So you're going to divide equals to this tax, your annual tax divided by 12. So it gives you your monthly tax, which is 167,000. So your take home is 1,250,000 minus your monthly tax, which is 167,137.5. So your take home is 1,082,862. So let me copy. This is your take home under the old law. Old law. You see, your take home under the old law is 1,067,000. Your take home under the new law is 1,082,000. So effectively, you are taking home a bit more money. It's not significant, but it's a bit more money. You take home a bit more money because when you're taking at least 15,000 naira more monthly. So the idea for this calculation is to show to you that you are not necessarily paying more taxes under the new tax regime. You're paying less taxes, right? Depending on if you're not earning significantly more. So, but once you start to earn more money, I will put a link to this sheet so you can do the calculation yourself, or you can even go to the fiscal committee's website. I'll put the link in the description where you will see, you can actually run this number yourself. So if you earn more, you can also do the calculation yourself, and you would see that the tax rates only increase when you start to earn somewhere around um over 25 million a year. In fact, around 30 million a year rather. Your annual pay is over 30 million a year, which effectively, if you're earning over 30 million a year, what it means is that your monthly pay, let's see, 30 million. If you're earning 30 million naira a year, it means that your monthly pay is supposed to be around 2.5 million. So if you earn around 2.5 million a year gross, that's when your tax starts to see a slight increase. It's not significant. People that see a reasonable increase is around 50 million. And I don't want to keep this video too long. I would have done the calculation for 50 million. Maybe in another video we'll do it and we'll see. But I'm hoping that with this explanation, it makes sense to you how to calculate your taxes, and you will no longer be misled as to whether your taxes are going to increase or not. So one of the things you should take away from this video is that you need to ensure that your employer is actually remitting your taxes when they deduct your taxes from you, because a lot of people deduct taxes but they do not pay. So you need to always ask for evidence of remittance from your employer. Most times you get an SMS for some states in Nigeria, the tax authorities will send you an SMS, like in Lagos State. For some, you might not get an SMS, but you need to get something called a tax clearance certificate at the end of the year, right? And that would show how much taxes your employers paid. Because if you keep paying taxes, the taxes are deducted from you, and you don't have proof, you don't have a tax clearance certificate showing that you've been paying your taxes, there are a lot of benefits you won't be able to access anymore in Nigeria starting from January 2026. And so you need to ensure that you take those kinds of matters very seriously and ensure that you get the certificates that you need, because you never know when you need those certificates. You might need it to register a new vehicle, to register your land at the land registry. You might need it to, when you are trying to bid for a government contract. There are a lot of things that you would need a tax clearance certificate for. And so if you're in paid employment, ensure that your employer actually remits your taxes and get the evidence of remittance. So I'll see you on the next video. On the next video, I think I'll be speaking a bit more to the freelancers, people who are not in paid employment, but who also want to understand what their tax obligations look like. I'll be explaining, that as well. And particularly for those who are working as freelancers in Nigeria for foreign companies, and those working in Nigeria for Nigerian companies. How do you comply with your own taxes by yourself, because you don't have an employer who is deducting your tax at source? Be on the watch out. You would get the notification once I release that video. So I'd encourage you, turn on your notification, follow our pages on social media, subscribe to our YouTube channel, and you'll get notified once the video is released. Thank you. See you.